Hi everyone, today I'm going to talk about the key component of the strategic profit model and how it can be used to examine the effect of logistic decisions. The firm's logistic decisions will always impact on a firm's revenue. Strategic profit model or DuPont model is a ratio methodology to examine firms' financial performance and return on investment. It is also a framework for conducting return on net worth. Return on net worth is a ratio indicating how well does the business utilizing shareholder investment to create returns. Also can be used for comparison with other business in the same industry. To calculate this ratio, first calculate the net return generated by the company. The equation for the return on net worth is assets times financial leverage. For return on asset, it is net profit margin times asset turnover. The three key components of the strategic profit model are profit margin, asset turnover, and financial leverage. Firstly, the profit margin is the revenue remaining after all operating expenses, tax, interest. The higher the profit margin will result in higher return on equity. Looking at the model, the total expenses and income expenses are subtracted from the gross margin giving the net profit, then divided by the sales to give you the net profit margin. The logistic manager can increase the profit margin by increasing sales, reducing cost of goods sold, decreasing variable expenses, and decreasing fixed expenses. For example, the company can increase sales by reduce the lead time in supply chain and the delivery time, using online store to cover wider range of target customers and make them feel more convenient. Improve after-sales services to build strong relationship with customers. The cost of goods sold can be reduced by reducing storage costs, using floor space effectively, volume purchasing, concentrating operation in single location, reduce waste, reuse or resell. For decreasing the variable expense, logistic managers can use technology to reduce labor cost, improve quality control, use cheaper alternative materials. Secondly, asset turnover measures a business efficiency at creating revenue from its assets. It is calculated by sales divided by total assets. The better the asset turnover ratio means the business generates more revenue per dollar of assets. To improve asset turnover, logistic managers can reduce the amount of inventory and reduce the accounts receivable. To reduce inventory, the business can optimize order size through accurate demand forecasting. Business can reduce ordering quantities, but also order enough to meet customer demands. Moreover, to reduce account receivable, business have to follow up the client to ensure the payment received on time, invoice payment terms and conditions, and make sure they are clearly listed. On the other hand, logistic managers need to be cautious in making decisions, which will impact on asset turnover as it may influence on the net profit margin, as well as the variables in strategic profit model can be changed independently, but they are dependent on one another. Thirdly, the final key component of strategic profit model, financial leverage. Financial leverage is the degree to which a company uses fixed income securities such as debt and preferred equity. Increasing in financial leverage and return on asset will lead to increasing return on net worth. There is a positive and negative in financial leverage. The positive financial leverage means that with the fund from creditors, the asset acquired generates a rate of return that is higher than the rate of interest or dividend payable. Alternatively, a negative leverage means that the asset acquired generates a return of that is less than the rate of return, interest, or dividend payable. But high financial leverage also involves high risks. In conclusion, profitability analysis is very important in assessing logistic activities and propose changes to a firm's logistical systems. By using the strategic profit model, logistic managers will notice whether changing the logistic system can affect the firm's return on asset or financial performance. Thus, can make the best logistic decisions that is suitable for the firm. Thank you for listening.